The most dangerous thing about the 1929 stock market crash is not how fast it happened, it's how normal it felt while it was building. People didn't wake up one morning and decide to destroy the global economy. They woke up, read the newspaper, checked stock prices, and felt proud, because America had finally figured it out. Prosperity without limits, growth without pain, wealth without work. At least, that's what it looked like. And that's why this story matters right now. Not because history repeats perfectly, but because human behavior does. Let's go back to the 1920s. The war is over. Factories are humming. Electricity is spreading. Cars, radios, refrigerators, technology is everywhere. America feels unstoppable. For the first time, ordinary people can buy modern life on credit. Pay later, enjoy now. That idea doesn't stop with appliances. It moves to the stock market. At the time, stocks were no longer just for bankers and the wealthy. They were for shopkeepers, taxi drivers, teachers. Newspapers printed stock prices every day. Brokerage offices opened on busy streets. Owning stocks became a social signal. You weren't just investing, you were participating in the future. And the future looked guaranteed. Here's how the system worked in very simple terms. You didn't need much money to buy stocks. You could buy them on margin. Margin meant borrowing most of the money. You put down maybe 10%. The broker loaned you the rest. The stock itself was the collateral. If the price went up, you made money on money you didn't actually have. If it went down, well, we'll get to that. As long as prices kept rising, this felt brilliant. And prices did rise. Between 1924 and 1929, the stock market more than doubled. Some stocks tripled, others went even higher. People stopped asking what companies earned. They asked how fast prices were rising. That's an important shift, because investing quietly turned into speculation. The hype was everywhere. Economists claimed the business cycle had been tamed. Politicians spoke of a new era. One famous economist said stocks had reached a permanently high plateau. Permanently. That word should always make you nervous. Behind the optimism, cracks were already forming. Corporate profits were growing, but not as fast as stock prices. Wages were rising, but unevenly. Farmers were struggling. Debt was piling up. But none of that mattered to the market. Because markets don't respond to facts, they respond to expectations. And expectations were euphoric. Here's the uncomfortable math that almost no one paid attention to. When you buy stocks on margin, small moves matter a lot. If you put down $10 and borrow $90, a 10% drop wipes out your entire investment. Not partially, completely. That leverage made gains feel easy. It also made losses lethal. Now imagine millions of people doing this at the same time. Banks were lending aggressively. Brokers were encouraging it. Regulators barely existed. Why stop the party when everyone feels rich? By 1929, margin debt was exploding. People were essentially stacking bets on top of bets, and the market became fragile. Not because companies were worthless, but because the system had no shock absorbers. Then, slowly, almost politely, things started to wobble. Early 1929 saw choppiness. Prices stopped rising smoothly. Some investors took profits. Nothing dramatic, but in a leveraged system, hesitation is enough. When prices dip, brokers issue margin calls. They demand more cash. If you can't pay, they sell your stock. That selling pushes prices down further, which triggers more selling, which forces more selling. It's not panic at first, it's math. By October, the pressure became visible. October 24th, 1929, later called Black Thursday. Selling surged, prices dropped sharply. The ticker tape fell hours behind because there were too many trades to record. Banks stepped in to buy stocks and calm the market. For a moment, it worked. People thought the worst was over. That false relief is one of the most dangerous moments in any crash, because it convinces people to stay in. Then came October 28th and 29, Black Monday, Black Tuesday. There was no dramatic announcement, no single headline that caused it, just relentless selling. 16 million shares traded on Tuesday alone. Prices collapsed, fortunes evaporated. But here's the part most people misunderstand. The crash did not immediately cause the Great Depression. The crash was the trigger. The system failure came after. Banks had lent heavily to investors. When stocks collapsed, those loans went bad. Banks began to fail. When banks fail, credit disappears. Businesses can't borrow. Consumers can't spend. Factories slowed. Workers were laid off. Fear replaced confidence, and fear spreads faster than optimism ever did. People rushed to withdraw their savings. Banks didn't have the cash. More banks failed. This feedback loop crushed the economy. By 1933, unemployment reached around 25%. Industrial production collapsed. Global trade shrank dramatically. What started as a market correction turned into a decade-long disaster. Here's the irony. The crash was loud. The depression was slow. People remember the dramatic charts. They forget the years of grinding hardship that followed. And the most uncomfortable truth? The crash didn't require villains. There was no secret cabal pulling strings, no single bad actor. Just normal people responding rationally to incentives. Easy credit, rising prices, social pressure. The system rewarded risk until it punished it. So what does this mean today? It doesn't mean every bull market ends in a depression. It doesn't mean leverage is always evil. It means systems built on confidence are unstable by nature. When prices depend more on belief than cash flow, they become sensitive to doubt. When debt amplifies gains, it also amplifies fear. And when everyone believes this time is different, it usually isn't. The 1929 crash wasn't about ignorance, it was about certainty. People were sure they understood the future, sure the system was safe, sure growth was permanent. That confidence didn't disappear overnight. It cracked, then fractured, then collapsed. So, here's the question worth sitting with. In our own time, with new technologies, new markets, and new financial tools, which risks feel invisible right now? Because the next crash, whatever form it takes, won't feel obvious while it's forming. It will feel normal, comfortable, even rational, until suddenly it doesn't.